The month of May is over. The scoreboard tells us that the S&P 500 was up 6% for the month, the Dow up 3%, and the NASDAQ up 10%. This continues the rallies from the April lows, which of course never should have gotten down that low in the first place. We'll tell you what happened last week, a little peek backwards, and what to expect in June, Q3, and the rest of 2025. Here we go. The clients of Perry Capital understand and recognize that the central thesis of our strategy and forecast is that the reset of the global trading system will be favorable to the U.S. economy. We believe it'll be good for growth, and we also believe that it's going to be very good for lower inflation expectations. Cases in point. In the last week, the Atlanta Fed raised their GDP forecast for the second quarter to plus 3.8%. It was negative about 3 weeks ago. The PCE number, the Fed's preferred measure of inflation, was reported Friday at plus 2.1%. This is the lowest number since 2021. So inflation is much lower than most people expect, and growth is going to be much higher. I'm really surprised that the opposite narrative is so pervasive in the marketplace. I don't think people are looking at the numbers, or at least they're not seeing the numbers that I see. The fact is that surplus nations have to cut prices to offset tariffs if they want to maintain current manufacturing export capabilities. That's the bottom line. Perry Capital has argued for months that long-term generational wealth is best suited to be invested into the United States. The reason we say that is because the U.S. economy has clear advantages over every other economy on the planet. The strength of that advantage comes down to two things, really: the labor market and regulations. With respect to the labor market, the U.S. economy has 170 million people working here. Maybe it's even 180 million people working here. It's never been higher. Unemployment's at 4.2%. Wage growth is at 4.3%. No other economy on the planet can match those numbers. Number two, the labor force is the most productive in the world. Productivity in the United States workforce is 2 times higher than that of Europe and Japan. And that productivity is rising. As far as regulation is concerned, the U.S. economy is structured to support entrepreneurship, innovation, and technological advance. Part of that regulation is capital. We have the deepest capital markets in the world, the most liquid capital markets in the world, and there is a rule of law that protects investor capital. As far as new businesses are concerned and that entrepreneurial spirit, I saw a piece of data this week that said that new business applications in the U.S. market are up 200% over the last 10 years. In Europe and Japan, that percentage is 25%. So investor capital does feel safe here, and innovation is rewarded. Look no further than the Morgan Stanley Composite Index of Market Capitalization in the global stock markets. Total market cap is about $80 trillion. In the US, it's 60. The rest of the world combined is 20. Investor capital is protected in the United States of America. That helps everything. Investors have long recognized that the decision to invest capital in the United States is a very rewarding experience. I saw a piece of data this week also that said that invested capital in this country over the last 20 years has had an annual return of 21%. Europe's is about 10%. Nobody else comes even close. So the point is, it's been a very good place to be. Problem right now is this structural shift in U.S. policy is very disruptive. I would argue it's disruptive by design, and many investors doubt the endurance of U.S. dominance. And that's fair, and there is money going into Europe, and Europe's had a good return this year, and so has Japan. But don't confuse a tactical shift to a structural change. Disruption will stabilize. U.S. economy will decrease taxes. That's going to be good for business. They will increase deregulation. That will be good for business. They will decrease spending. It's going to be harder than most people thought, but it's coming. We've already cut $200 billion. That's a good start. Probably get another $200 billion by the end of the year. Trade deficit is falling. We saw this week that the trade deficit was down 50% last month. Joe Lavorgna, my economic friend, said that that's worth $300 billion to the U.S. economy that goes right to GDP. That's one of the reasons the Atlanta Fed increased their GDP number. So the point is, the U.S. economy is disrupted, policy shift is changing, and it's going to make a lot of people uncomfortable, but do not lose sight of the fact that it's being done for a reason, and that is that national debt will go down, and the budget deficit will go down, and the trade deficit will go down, and the U.S. economy will benefit. Okay, so let's get to that forecast. First of all, clients know that the exposure into the U.S. equity market that Perry Capital had at 87.5% was the highest of all time, and now it's back down to 75%, which is still pretty high, but some risk off the table. Two reasons. Number one, they've got to cut spending in Washington. The House bill goes to the Senate. The Senate's got to get its own bill. They've got to reconcile that. I don't think it's done by June. I really don't think you need to get involved in the market if you're not in it, because I think it's going to be sideways at best. Secondly, the confrontational temperature around the world is rising a little bit. Trump has called out the Chinese, the Iranians, and Putin, not to mention Powell, in the last week. I think the confrontational dialogue is negative for the market, and I think that all three countries will test the mettle of the new administration to see how far they really will go with respect to tariffs and peacekeeping initiatives. So that's a negative. I also think that you need to be overweight technology, and the simple fact is, I can just give you some numbers. NVIDIA is up 24% this month. Very good month for that stock. And the main reason for it was their earnings were out and reported on Wednesday. Revenues were up 69% and profitability was up 37%. It would have been over 50% if they hadn't written off $8 billion worth of investment in China. So the company continues to be a leader in the AI space. I think everybody should own it. I think the stock's going to probably double in the next 5 years. Oh, they're that far ahead, and I'm not kidding. The Mag 7, that's changing a little bit. I don't really like some of the companies in there. I don't want to call them out right now. I'm going to change, but I do think an overweight in the technology sector is going to be a very good bet going forward. I would definitely be overweight there. The government's supporting it, and there's a Cold War on against the Chinese in the AI space, and the U.S. economy cannot afford to lose that battle. The second thing I have is defense stocks. I've got a position in the defense ETF in this country. You can get other ones. There's a European one, there's a global one. ITA is ETF I own, is up 14% on the month. I expect that will continue to outperform as well. So overweight defense, overweight technology, and be a little bit more selective in some of these spaces here, but you can look at my portfolio and see what I have, and we can talk about it anytime you want. I don't think the stock market's going to make a new high in June, probably not in July. I do think it will make a new high by the end of the year, and I think it'll outperform every other stock market on the planet for the next 6 or 7 months. Okay, there you go. All right, good luck. Thanks a lot. All the best. Bye.